Today lesson we will go through our LO1 learning outcome 1. As you know, we are in a new setup. Means if you have any question, drop me and I'm Jim at you can stick that contact info. I'll try my best to get back to you as soon as possible. So this lesson is about just 1 second. I'll show you and we'll start. Okay, financial management. Okay, let's please, my name is Anjum Satar. If you have any questions, please drop me an email anjum@university.co.uk and I'll try to best get back to you as soon as possible. So today lesson will be, before starting, let's go through the unit specification, what we're supposed to learn. Okay, in this unit, the key aim to develop the understanding about the financial management, small, medium enterprise. We'll go through application and analysis of the fund, capital investment appraisals will be discussion on how we can use and appraise the project by looking at the cost of capital. So our learning outcome 1, which is be able to apply investment appraisal methods. We're looking at these and I'll give you the separate slide application of the investment appraisal method. So apply the appropriate investment appraisal technique, evaluate, justify, analyze, and apply. So these are the key assessment criteria and the merit and distinction criteria which we're supposed to go through. The lesson 2 will go through advice of managing risk. Lesson 3 will go through understand the long-term sources of funding. So today lesson will discuss about appraise the method, capital budgeting, which is mean investing in capital assets, which we'll go through and appraise, checking the performance of each option, which one is the best. So we'll go through payback period and ARR, accounting rate of return, and NPV, net present value, internal rate of return, and balance scorecard model. That all will be in our discussion. Okay, let's please, we'll start lesson 1. Give me 1 minute, I'll show you. Hope you can see now slides. Let's please be able to apply the investment appraisal methods, apply the appropriate investment appraisal technique, evaluate and make justification, recommendation, and critical success factors. Then we'll discuss about capital asset pricing model. That will be the key. Apply appropriate investment appraisal techniques, money in and money out, for the business return in futures. What do company invest and how does the company measure the value of investment? So capital budgeting involves the purchasing asset now and the return for the future benefit. So we look the cost and the benefit analysis and always keep in mind when we are investing in capital assets, so we can think about capital allowance which we can claim from HMRC as well. The cap, it depends upon the management ability to choose the best investment option for those available. That's really because we have a limited resource, unlimited one, so we need to make sure we'll invest, the money will get more output, more return. Okay, this is referred to the capital budgeting and investment appraisal. The stages, which stage 1 determine the investment funds available, identify profitable project opportunities, and refine, classify the proposed project. So that's the crucial, the stages which we can look around, evaluate the proposed project, approve the project, and monitor and control the project further. We can look around, identify the objectives, search for the investment opportunity, list all possible outcomes, measure the payoff, and select the investment appraisal, obtain the authorization and implement project, and review the investment appraisal decisions. Okay, so main investment appraisal method, it can be discounted cash flow, which is NPV, internal rate of return, non-discounting ARR, and payback period can be, and accounting rate of return is net income and asset is expected to generate divided by the average capital cost is expressed in the annual percentage. So we can look around project A, project B, how much is the return of each. Higher will we accept the project and lower we reject the project. Okay, then we have the formula for ARR, average estimated average accounting profit divided by the average investment, where we can say capital cost plus residual value if we have divided by 2, so we can find average. Okay, in term of the decision making, if the ARR is equal to the greater than the required rate of return, the project is acceptable because the company will earn the least, the return rate of the return. ARR is less than the required rate of return, the project should be rejected. Thus, like if you deposit money in the bank at the moment, base rate is 5.25, so you can get around the interest rate for 5%. So if your project give you only 2, so you can think about keeping in view of other factors as well, and you can decide which one is the best. Of course, return is average less than the bank, with the high risk you're taking, and so that's not good to be invested in those projects. So advantage relatively simple, link to the other business measures, looking at the full life cycle of the project, that's quite crucial. Disadvantage based on the profit, not on the cash flow, ignore the length of the project, ignore the time value of the project. Okay, so payback is a simple method based on the cash flow, ignore the time value of money, lowest pay time and the best, which we can define the time taken to the initial investment, and equal to the initial investment. So we can look around the companies usually require the time limit, like, how long the payback. So relatively simple, easy to use. Disadvantage of this method is ignore the cash flow, time value of money, and total return, because especially like investing money in education, innovation, benefit can be huge and can be for longer period of time than for the short period of time. So NPV, net present value of all the future cash flows, positive and negative of the entire life of the project, discounted present value, which we can find what will be the real value of the money. So it is expressed for the determine the value of the business investment, security of the capital, and the new ventures. That's all which we can look around. Anything involved in the cash flow, that's we need to be guys. We can look around NPV, like 1 divided by 1 plus R. You can use the discount factors, and we can take out the initial investment, and we can find which one is the best. So on the basis of this, we can decide which project and how many years will take, to get there. If NPV positive, we accept the project. If NPV negative, we reject the project. Advantages consider the time value of money is the absolute measure of the return based on the cash flow, not on the profit, and consider the whole life of the project and link to the maximized shareholder value. Difficult to explain for the managers what is uh, income statement, the cost of capital, and relatively is complex. So net present value is the decision rules. If the NPV positive, should accept the project, negative reject. If the project have more positive, highest positive compared to other projects, we accept. Internal rate of return, that's, we need 2 NPVs, one positive and negative in between, that we can expect higher IRR is better. So other expected compounding annual interest rate, they will be on the project. Okay, so internal rate of return, it can be discounted rate, and that can be make, the net present value of the project, and it can be which we can look around the in other words, it is expected compound annual value of the return will earn on the project. Okay, internal rate of return advantages consider the time value of money percentage, easy to understood cash flows, not profit. Consider the whole life of the project. If the IRR is greater than the shareholder required rate of return, accept. So limitation, not an absolute measure of profitability. Interpolation is the only estimate and fairly complicated to calculate. and non-conventional cash flow may be the multiple IER exists and no reinvestment can be issued. So we can look on the popular measure the performance, non-financial performance, measure the financial data, design the comprehensive, link the company's strategy and objective, and like the performance measure can be assessed, and can be seen as the cause and effect, the performance. Performance always look, in time, in the cost, in the quality. Then we can look around according to the Kaplan Norton. He's the popular author. He said performance not look in one perspective, look the financial, customer, internal, and learning and growth perspective. A couple of you have experience, so we don't have a Nokia anymore because the reason they focus on the financial perspective, innovation, learning, and growth perspective. They close many research and development centers throughout the world. That's the biggest problem we have, so we need to look around the objective, measure, targets, and in initiative, internal the progress, objective, measure, target, and initiative. We can look around the learning and the goals. Is the objective, measures, target, and initiative, customer objective, name it. So we can look around these. So, like, we can look around the balance scorecard, we can look around when in the financial return and capital employed, cost per flight, we can look around internal perspective, improve the turnout time, minimize delays, every time on the ground between the flights, as which we can look in the airline industry. So objective is set competitive. So these, different perspective we can look around, and that's help to measure the performance, not one perspective, look all the perspective. Okay, then we have assessing the performance. The shareholder value is the value derived from the equity owners and the corporation and the management ability to increase the sales, earning, and free cash flow, which leads to increase the dividend and the capital gain. The company's shareholders' value depend on the strategic decision made by the board and the management, include the ability to make wise and investment. If this value is created, and particularly over the long time, if the share prices increase and the company can pay larger cash dividend, and the shareholder value, we need to look around the increase the shareholder value, increase the total amount in the stakeholder equation and the balance sheet. Assessing the values, creating the shareholders value. Okay, nowadays, of course, we not only focus on the shareholders value, we are looking the stakeholders value, which is mean that anyone who has any interest in the business, not only just the investor. So strategy management, reward and compensation, and we need to be look around everyone's interest, not just assessing the performance. We can think about the economics value being paid to the financial and the return earned by the companies, except the amount that the company need to be earned and fulfill the expectation of the shareholder. EVAs also consist of the rate of return invested with the opportunity cost. If they invest somewhere else, what they can earn. Conversely, the negative outcome, which mean the company destroying its value with the investment and the capital, would be better to spend. Assessing the performance, economics value is equal to EV is non-operating profit. We can and minus weighted average cost of capital times by the capital invested. So we can find it like you will see the examples. Capital invested in these years and weighted average cost of capital, cost of equity, and cost of debt. Finance charges we have. Then we have net operating profit after tax. This and the finance cost we have, and then we can say economics value. Yes, because the difference between that's the way we can calculate. And 1.2, make a justified recommendation capital investment. So money used for the business to the fixed assets such as land, machinery. The money is invested in the business, and understand the money is used to purchase the fixed asset rather than the company need to pay. That the capital asset can bring longer term economic benefits. So what is the definition about asset? Anything you own it which flow the future economics benefit. Capital investment can be made in the form of the debt financing, equity financing. That is always, or we can hire the money from the angel investor, venture capital, or the capital market. Okay, objective to acquire the additional capital, expansion, enabling the businesses take the advantage of the new technology, advantage in the equipment and the machinery increase, reduce the cost and replace the existing asset. Latest, and that's help, always look the cost and benefit of each decision, whatever you make. The key consideration we need to be investment appraisal and analysis and appropriate, approach we use. We can think about the payback period, whichever is the lower, and mutual exclusive investment options can be. So we need to look around. And growth and decision option, the capital investment are often made not only the immediate the cash from the project, but we also look around the economic value derived from subsequent opportunities. For example, the firm is undertaking the research and development, strategically position themselves economic value from the commercialization and the market condition. And similar, the firm use the foothold investment in new foreign market. Anyone, any question, please? So we can look around the key consideration and recommendation, which we can look around the determine the appropriateness of capital, weighted average cost of capital, indicate the minimum rate of which the company should earn from the business in order to return on the finance, calculate the appropriate cost of capital and reflect the risk of the business, determine the difference in initial investment and the present value, future of the cash flow. We can look around the tax consideration, all the cash flows, capital investment decisions should be after the tax, the cash flows. Company leadership and management should be hold each other's, accountable, and projections of the cash flow. An example of the community, we can look around after the tax. So key consideration and recommendations are non-financial factor, corporate culture, commitment to quality, the researching, consider human resource and industry trends. Okay, then we have 1.3, analyze the critical success factors, CFF, in any organization. Critical success factors are the key points, those are the execute and expand, which we need to be ensured the development and the growth of the company. Businesses as the achieving or the crucial factor of the key performance which you can, So we can look around the contrast when same factors overlook, are ignored, they will contribute the failure like research and development. Critical success factor need to be found through the study of the company's strategies. Critical success factor have managed to define and guidance and implement, the process of control, IT, and all of this we can look around. Automotive industry, the vehicle style, fuel economy, compliance with the environmental legislation, efficiency, distribution, and network. Computer industry, we can look around the quality of sales, user acceptability. Food industry, we can look on effectiveness of advertising, efficiency. In companies, we can look at the recognizing the inspector competency, quality. That's why. So CSFR pre-planning always effective. We can look around the pre-plan things. You do the environmental, you do the research. That's why we call the data information and knowledge is very important. We can manage it and the need to perform for the assessment of each project. It can be investment appraisal, risk planning. Of course, risk is being probability of happening something. Always we can look around the risk high, low, medium, and the basis of this we can decide which project you wanna go and how you wanna go. Yes, that's quite crucial. CSF is critical success, resource planning, risk planning. Resource planning, how many resources like man, material, and money, cost, functionality, diversity, they're also affecting performance in the organization, ultimately increase. Risk planning is best, mitigate, the recognizing the upfront and managing them throughout the project life cycle, and the company should, the play the process, the analytical and the risk, life cycle throughout the life cycle of the project, carry on continuous risk analysis throughout the project. CSF asset, integrity planning is quite crucial, which we can look around the asset honestly, show the real value of the asset, not the creative accounting like Enron, which we can look around the stakeholders management. That is also by liaising with the external stakeholders, organization should ensure that's, which we need to, that can be used. Okay, CSF, which is called critical success factor project acquisition, is very important. We can look around the chain management, proactive scope of control, chain management. According to the Levin's three-step model, unfreeze, chain, and refreeze like using AI and various other technology. If you don't, it is a risk, the breakdown of the mismanagement, exemption, discontinuity. Ideally, project must be executed and little change is possible, as maybe change and ripple effect can be happen on the organization. Then we have a 1.4 where we can look around capital asset pricing model and weighted average cost of capital. Always good to look around which is the models here return on on which we can look around the various project rate of return. That's rate of return is very reflective on the risk and the fund, the cost of fund. That's which we can. Anyone any question, guys? Please, which we can. Cost of equity investing debt. So discounted rate of return, we can look around which is investment appraisal on the basis of this, which is anti positive, we can accept it, negative, we reject. Okay, then weighted average cost of capital is the obvious approach, on the cost of each, the source of finance, like you want equity finance, debt financing, their real net value. On the basis of this, you can decide which project you want to do. Equity, the cost of equity and that, which can be measured, and the method of calculating equity, dividend evaluation model of the capital asset pricing model. So cost of equity, which is a cost, the dividend, the purchase price, which we can with the cost and the dividend and the price, the share, which we can calculate by using this equation. And the next lesson we look, the DVM measures in the market value or the share price, and we can based on P or DO1 plus G, K minus G, which is G represent the growth rate. Estimated. So please, that's formula we can use. Cost of equity, we can look around how much the dividend we paying, how much we expecting growth rate there, and that's the way we can look around the real value. And the cost of equity, how much was the equity previous year, what was the risk factor, beta, risk rate, and all, this equation we can use. The cost of capital and cost of equity. So systematic and systematic risk is good to be the beta is risk factor, unsystematic alpha. Unsystematic risk can be diversified the portfolio, like don't put eggs on one basket. That can be example. The beta is determined by the revenue and the cost sensitivities and the causing the variation. So that is quite crucial. Expected return, equity share increase, the risk. So we need to. So this measurement, so we can look at if the beta is equal to 1, if the systematic risk of the share is stock market greater than 1, if the risk is market as a whole and aggressive shares, greater than 1, the defensive shares. So we can look around these shares and the risk of return. So cost of equity and capital, like the bank loan, we can calculate the share. Borrow 1 million, 10% you pay. If the company pay the corporation tax, of course, the increase of 10 will be the cost. So it is 23 you pay. So that's the way we can calculate the cost and net effect each of this. We can look around and tax, in terms of, because if you pay the dividend now, the equity is more expensive than that. If we can use the formula, the value of debt, value of equity divided by value of equity plus value of debt. If we can work on the cost of equity is equal to value of debt plus value of equity plus value of debt. AD is the cost of debt, 1 minus T, because we can save on the tax. That's why we use the T there. T is the tax rate. So that's the way we can calculate here in the example, guys. We have calculated, and then I included the links for you. Please, you can look around and further enhance our understanding. So next lesson, what we'll do, we'll look, the method we learn. I'll give you the example, some medical which we use, and we'll calculate investment appraisal, NPV, and payback period, and weighted average cost of capital. So these are the crucial method which we need to be. So anyone, any question? Yes, yes, no. Oh, no question. Okay. So guys, thanks for attending. We keep up to here. Hope I will speak to you all during next lesson. Have a wonderful weekend and speak to you all. Thank you. Bye-bye.